Hi, everyone. My name is Erica Dagnan-Minahan, and I am so excited to have everyone here for our first episode of the Series A list. So thank you so much for joining me and our wonderful guests today. I'll give everyone a few minutes to come online. I know that takes a minute. So welcome.
Thanks for having me.
Yeah, thank you for being here. So now that we've got a few more people coming into the room, I just want to say again, hello and welcome to the Series A list with Rain Ventures, the live webcast where we will be introducing you to some of the top early stage venture capitalists in the world. The world of venture capital has long been shrouded in mystery, and most startup founders are really unsure of how or if venture capital can be a tool to help them grow their businesses. So today we're going to be pulling back the curtain of early stage venture capital, introducing you to some of the top investors in the space and answering the big question, what does it actually take to get to Series A? So I'm Erica Dagnan-Minahan, founder and managing partner of Rain Ventures. And today I am so excited to welcome our very first guest, the founder of ENIAC Ventures and Human Rolodex, Nihal Mehta. Nihal is also a 5-time serial founder and has written over 15 books and white papers on entrepreneurship. And really impressively, he also has a dual degree from Penn in both philosophy and computer science. So a gentleman and a scholar. Welcome, Nihal. How are you doing today?
Good. I'm doing great. Thanks for having me.
Yeah, thank you so much for being here. So before we get started, I want to remind everybody that we are really excited to take your questions at the end. We'd love to keep this pretty interactive. So please add any questions that you have for Nihal to the Q&A tab. And if you're in the chat, please log on, say hi, and let us know where you're tuning in from. So Nihal, before you launched your venture fund, ENIAC, you were a founder. Can you just tell us a little bit about the first company you started and what inspired you to become an entrepreneur?
Sure. First company that I started was a spectacular failure. I say I was very lucky to have failed very fast, and very lucky to have had that experience as my first venture. It started in my senior year house with my roommate in Philadelphia at the University of Pennsylvania. So this was in 1998 and 1999. I'm dating myself now. And, the website was actually just originally my roommate and I were DJs on campus. And so back when DJs were cool, we're not kind of a press a button on an app type of thing, or press a button on a CDJ and beat match. This is with vinyl records and Technics 1200s and a mixer, and you have to listen. And anyway, no bitterness here. But anyway, my roommate and I were DJs, and we used to obviously play a lot in the city, and we used to have a list of events that were cool and were happening, and we started an email list with our friends, and we decided, hey, we should turn this into a website, right? It's 1998 and 1999, like .coms are what's happening now, right? So of course this is 20 years ago. And so it became my roommate and my senior thesis, and the site that we launched, and the company first startup that we started was called phillytonight.com.
I love that back then you had to put the .com at the end just so people knew that you have a website.
well, actually, the .com was the key to raising money,
Yeah.
because any .com back then was like, where do I invest, right? And this is, of course, before the big crash of 2001. So, needless to say, we raised a bunch of money mostly from like Indian aunties and uncles who just wanted to invest in like a .com, and we cobbled together about $1 million from like 40 different people. And we spent that money really well. We had like a huge office on like 2nd and Chestnut in Philly. We had a billboard on 95. We had commercials on MTV. Actually, we had a commercial done by The Roots, beatboxing, and we had up to like 40 employees. So we really spent it well. And I say we spent it well because, a couple of years later, we ran out of money. We had less than, 10 or 20 grand in revenue, and also not from our core business models, which were online advertising. This, of course, is pre-Google, so there was no large ad network to help you monetize your inventory. And so we had our own sales team selling into venues, nightclubs, restaurants, bars, um, kind of a Yelp business model, right? Pre-Yelp. And anyway, very hard to collect money from these folks. We had to hire like big, strong people, the muscle we called it, to like go and shake down nightclub owners to like pay their bills,
Yeah.
which we often didn't collect. But anyway, we ran out of money. 2001, what do startups do? They keep on raising more money. And obviously, the crash happened. We weren't able to raise money. Hundreds, thousands of other startups were in the same position. And we had about 400,000, I think, 500,000 of debt on our balance sheet, and no way to make that up. And so we had to do the unthinkable. I was in my very early 20s, and we had to file for bankruptcy in 2001. And so that was a very humiliating and humbling experience, um, especially having been the pride and joy of all these Indian uncles and aunties. Now at like the Diwali party, in the corner, you could hear them whispering, "That kid filed for bankruptcy." Um, so it was a very humbling experience, but I would not give up that experience for the world. I think when you obviously you learn the most from your failures. I say you have a lot of scar tissue, but most importantly, muscle memory. And so the next time you're building a business, whether you're conscious or um, subconscious, you're consciously or subconsciously avoiding the same mistakes. And so, that was a great experience. That was my first business. And the rest is history.
Well, that's pretty amazing. I thought you highlighted some really interesting things there. Number one is that a lot of founders think that having a startup is about spending money, how they're going to spend the money versus how they're going to earn the money. And then number two, the importance of the friends and family round. Investors want to know that if the business doesn't work out, you're going to have to see some angry folks at the holidays. So quite interesting. You had your skin in the game there. Well, thank you for sharing that story. That's really interesting. Would love to maybe learn a little bit more about some of the successful businesses that you've started. I know you've started 5 businesses, and what you think some of the key takeaways there were, maybe based on the prior experience, and how you actually got the courage to throw your hat into the ring again.
Sure. Yeah. So I can tell you, that story doesn't end there, by the way. So we filed for bankruptcy, actually bought back the assets. Um, there was something that we built at Philly Tonight that I thought was interesting at the time, and it was essentially a text message platform way before SMS was cool, where we would text the user who opted in with an interesting event in their city, right, within their genre. So you could sign up for hip hop in New York City, and every night, this is 20 years ago, you would get a text message with our recommended event, right? And you could also show it at the door for entry, for a coupon, for a free drink, what have you. And so I bought that piece of technology that we built back because I thought there would be an interesting B2B application of that. So selling that into, record labels first and artists, but then brands. And so that company was called Ipsh, and I actually moved to San Francisco in 2001 to start that business. Ipsh is the sound that a record makes when you scratch it, and so it was a domain name my roommate and I had bought, and we thought it would be cool to start this text messaging company with that name. We later recreated the acronym Instant Power Single-Handed, but essentially saw a behavior that people were doing from a B2C perspective, meaning people were enjoying getting this new type of messaging on this new type of medium, at that time SMS, and actually helping brands reach customers on that platform. And so I bootstrapped that company in 2001, and we grew it up, ended up working with incredible kind of Fortune 1000 brands at the end of, 3 or 4 years. If you remember in 2002, um, those of you that were around and old enough, American Idol had come out on TV, and you could actually text in to vote on your favorite contestant. And so we ended up powering a lot of those campaigns um, with a short code that was innovative at that time across any carrier. So you could text in regardless of your carrier and actually interact with the brand. And so we started powering those types of campaigns on TV, on print, on CPG wrappers, like on Big Mac packages from McDonald's and Starburst wrappers for Master Foods. And so business started growing, and ended up 2005. There were a bunch of other venture-backed companies getting into the space, and we wanted to accelerate our growth. And so I went to two of our biggest channel partners, and a lot of our customers were agencies. And so we went to WPP and Omnicom to see if they would be interested in investing in the business. They ended up not only being interested in investing, but they wanted to potentially also acquire the business. And so got into a little bidding war at the end of 2005, and ended up, not wanting to sell, but ending up, hard to refuse an offer from Omnicom. And so sold the business to Omnicom end of '05. What was interesting about this journey, by the way, is after we filed Philly Tonight, actually turned to another company, Urban Group, filed that bankruptcy, bought the assets back. We actually moved over all the investors, those Indian uncles and aunties, into the new business, Ipsh. And so, they all got a return in 2005, which is great. And they got a write-off in 2001 from the bankruptcy. And so I think one thing I learned early as an entrepreneur and as a human is that life is long, and you always want to, take care of people that bet on you, because, most entrepreneurs, and now I'm on the other side of the table, will end up creating multiple businesses over the course of their lifetime, right? And to have that myopic short-term thinking is not the right move. And so we're really happy that we took care of those investors, and they'll never forget that, right? And we worked hard to have that outcome. That was a 6-year journey, 7-year journey, 98 to '05, through a bankruptcy, asset purchase, complete pivot from B2C, B2B. And by the way, 7 years is not typically that's probably an average, or even a smaller timeline for a successful company. If you look at businesses, that go public, like Uber, et cetera, these are decade, 9, 10, 11-year businesses in the making. And so it's about also having a lot of patience. But that was my first cycle, from B2C to B2B, from a complete failure to a success.
Well, that's so great that you were able to bring along the aunties and uncles. I'm sure they really appreciated it. And it's nice to have, be able to come away from a successful deal with that good feeling that, you really did right by everybody. And, would certainly love to highlight this, to folks who are listening, that, I've seen that kind of complex situation happen with pivots and restructurings, and it can be such a delicate thing to deal with, but, keeping your integrity there. And as you said, being there for the people who were there in the beginning is so important. Great. So, one of the things I'd love to know is, now that you're an investor, how has your experience as a founder affected the way that you evaluate startups for investment?
Yeah, I think a lot of lessons, obviously, we learned in the trenches are still very tried and true. That pivot from B2C to B2B, I actually did that again afterwards. After I left Omnicom, I started another business that was venture-backed in the B2C space called Buzzed, that failed, ended up pivoting to a B2B business called Local Response that was acquired. But, the one thing we always tell entrepreneurs is to fail fast. And you get the most learnings possible from that experience. Be very ambitious, and if you can, essentially aim your trajectory to the stars, you'll fail and land on the moon, right? Ideally, you've failed before we invest now as investors, right? And so we love meeting serial founders who have failed before, right? because, like I mentioned, they have the muscle memory, but they also have a chip on their shoulder, right? Like they're extra motivated um, to succeed. And you see this even in the most extreme entrepreneurs like Elon Musk, right? Um, or even the most motivated athletes, right? If those of you that watched The Last Dance this summer, the documentary on Michael Jordan, Scottie Pippen was not the first pick, in that draft, right? And one of his biggest motivating factors every morning when he woke up was to think about all the people that passed on him, right? Even after winning 6 rings, and it still pains him. And so that chip on the shoulder, that motivating factor is incredibly important. But more than anything, I think what we look for um, is founder market fit. So in other words, uh, these founders, this founding team, why are they uniquely positioned, maybe the only team on this planet to pull this off, right? And it could be, all the dots, Steve Jobs, all the dots connect backwards, but it could be something from their experience, from their upbringing, from their early career experiences, in which they've encountered some pain point that they're extraordinarily passionate about solving. And when they've aligned their passion with their work, it's magical, right? Because you're thinking about it, essentially this problem that you're working on more than anybody else, or at least as much as anybody else in the world, right? You potentially thinking about it 24 hours a day, thinking about while you sleep. Um, and so if you can think about it as much as, Bill Gates or Elon Musk or Jeff Bezos, then, you're in good shape, right? That's kind of the first step. And so we look for founder market fit. We ask ourselves, why are these founders really uniquely positioned to be the only team to pull this off? And then, of course, do they have this chip on their shoulder? Do they have this extra motivation? And that can come from a failure in the past. That can also come from some success in the past, too. Oftentimes, we'll back serial founders that have, had a previous company be acquired. But now they want to do it bigger and better, right? And so those are some of the things we look for in the founding team. Now we invest at seed, so this is the round before the Series A, and our job is to actually get companies to the Series A as quickly as possible with the best Series A investors. And at seed, there's not a lot of data. There's not a lot of revenue. There's not a lot of, daily active users, monthly active users, churn for a consumer product. For a B2B enterprise product, you're talking about MRR, you're talking about ARR, you're talking about NRR, which is a net retention rate of customers. You don't have a lot of that. You do have a team. You do have a product prototype. Hopefully you'll have some early customers, like design partners, pre-revenue customers. And so at seed, it's mostly about the team. The team then, based on the markets they're going after, the market and the product is really a function of the team. But we think about the way that we evaluate investments as kind of 80% team and maybe 10% market, 10% product. At the Series A, the story changes, right? Because that's where, especially these days, the bar is a little bit higher for the Series A, and that has to do with the business, with revenue, with CAC to LTV, with churn, whatever metrics your KPIs are.
So on that, I'd love to know, what do you think are the 3 most important things that a founder needs to achieve to get to the Series A? And how do you evaluate whether or not they're capable of doing it?
Yeah, it's a good question. One of the things we work really hard at when we're doing the seed investment is we actually talk to many Series A investors even before we pull the trigger on the seed. And that's the question we ask them. What do you need to see in this business to write the A check? And that helps us kind of reverse engineer, a plan for the company, so that, say, the seed of $3 million buys them 24 months of runway, that somewhere along month 15, 16, 17, so you still have cash in the bank, you're hitting those milestones, right? And some of those milestones are, if you're an enterprise company, enterprise SaaS, it's monthly revenue rate, right? Typically, and it depends on the industry, but typically a $1 million ARR, that's about 80K a month, and MRR is a good
And
metric.
for those of you who are maybe new to this, ARR is annual recurring revenue, or annual run rate, sort of depending on what type of business you're in, versus MRR, which is the monthly run rate or the monthly recurring revenue, depending on, I guess, what people want to say.
That's right. And typically that 1 million ARR is on a SaaS revenue margin, which means SaaS gross margin, which means the margin on that revenue is kind of above 50%, ideally 60 to 70%. So, if you're doing transactions or payments and only collecting, say, 3 to 5% of that, then you're going to need a lot more than 1 million, for example, right, to hit that Series A milestone. So that's kind of broadly B2B enterprise.
And this is for, right. And so he's definitely sort of referring to things that are, SaaS, software as a service business. If it's, a consumer products business or something with physical product, same thing, the bar might be a little bit higher, or definitely will be a little bit higher.
That's right. And then consumer products, as you were mentioning, if we look at, say, a new social network, the metrics there are things like daily active users, DAU, monthly active users, MAU. We look at the ratio of daily active users over monthly active users to see how many people are actually using the service every day. We look at things like churn, 30, 60, 90-day churn. So after 90 days, what percentage of your original users are still using the product? Churn is incredibly important. You look at things like viral coefficient. So if 10 users use your product, do those 10 users invite another 10 users to actually make the product go viral? So consumer has a totally different set of metrics, of KPIs, key performance indicators, than B2B enterprise does for the Series A. But listen, a good rule of thumb is, ask an A investor, what they'll need to see to raise a Series A. They'll be very open, very transparent. And the nice side effect of asking an A investor is you kind of get on their radar. You get on the hook, right? And when we're doing that in our seed diligence process, we're ending up fortifying that relationship for the A. They say that usually know who your investors are. You've already met them. You've already met even potentially the companies that's going to buy you, right? You've already met them. You're already building a relationship with them. So, you want to plant the seed, no pun intended, very early with downstream capital, with the Series A and Series B folks, so that you can learn what metrics they need to lead that round.
I love that you brought up churn, because I feel like it's something that can be the death of a lot of startups and is such an important metric. People are so focused on user growth and customer acquisition that they sometimes don't notice that they're shooting themselves in the foot with churn. So what would you estimate as kind of like a target maximum churn that you think would be acceptable for one of your portfolio companies, or a rate that they should sort of shoot for?
Yeah, I think for a consumer product, anything over 25% of your base that you're retaining after 90 days is pretty good. It's hard these days when you compete with Facebook, and obviously Facebook products, Instagram, but also other social networks like Twitter, because you're essentially competing for time against those platforms, right? So creating something that's super sticky, that almost becomes a utility, is really important. But by the way, past few years, ENIAC, our firm, has been investing probably 80% enterprise. Historically, it's been 50-50 consumer enterprise, but we've been investing more enterprise, and I'll tell you why. In the consumer world, you have these very large incumbents: Google, Apple, Amazon, Facebook, that essentially can buy network effects. So when a new, say, Facebook 2.0 comes out, they actually need to use Facebook, and Google as acquisition channels, right? To grow their app. That's where ads are shown. That's how they literally leverage paid user acquisition. So Facebook and Google actually have all of this data of like apps that are spending money on their platforms to grow. And so they can very easily copy them. And obviously Mark Zuckerberg's not afraid of doing that anytime, or kill them. And so because of that, because of these giant incumbents in consumer, we think, and a lot of other investors think, it's going to be harder and harder to build another YouTube or another Snapchat, another multi-billion-dollar consumer business that's venture backed, right? Mm-hmm. Not impossible. TikTok came out of it didn't come out of nowhere, but TikTok grew very fast.
It came out of nowhere.
Right. We have a company called Dubsmash that is a distant second to TikTok, that's now gaining steam after all the TikTok drama again. But anyway, for those reasons, I think we think consumers harder. Now, in the enterprise world, for a very long time, you only had one very large, north of $100 billion market cap enterprise company. That was Salesforce, right? Now you have Salesforce and you have Zoom and you have a few others. But there's still so many lanes that are wide open to create very large companies, right? You have Salesforce, you have SAP, you have Oracle, but there's so many other lanes that are wide open to create multi-billion-dollar businesses. And so for that reason, every investment we make, we need to think that, it could be $1 billion business. We think there's more opportunities in enterprise, but, as a founder, you should not pick a business based on where there's market opportunity necessarily. You should pick a business that you're incredibly passionate about, that you will work on for 10 years and think about 24 hours a day, 7 days a week. That does not feel like a job because you love it, because you think it needs to exist. That's where you'll be successful, not necessarily, picking a sector and a category that you think, needs to be exploited.
Yeah, no, I mean, I think that's great advice. But I do think at the same time, really sort of understanding the overall market dynamics and those forces that are going to impact your company is really important. So along that vein, let's just talk about venture capital, period, right? So what are some of the things that a founder should consider when deciding whether or not they should even raise venture capital?
VC is not for everybody. For sure. It's actually for sure a minority, right? This is capital that I think is largely misconstrued in the entrepreneurial community. Typically, VC is great for businesses where you just need to add a little bit of water for this thing to go. Businesses that could use the cash because the flywheel is already starting to turn. And so it could use the cash to accelerate much more dramatically, right? And that's typically what venture capital is for. Now I think on both sides, there's so much more VC than there used to be. And it's sloshing around in all different types of categories that, I think we've gotten away from that paradigm. But, we talk to and mentor so many founders every week, and have almost forgotten kind of just traditional avenues, right, for raising money. Obviously bootstrapping, but debt and loans, small business loans. The government actually has a bunch of different platforms for grants and for extremely low interest rate, growth opportunity loans. There are incredible number of crowdsourcing platforms as well, right? You have places like Kickstarter and Indiegogo and iFund Women and WeFunder, where you can post your business on these platforms, and you can even raise money from unaccredited investors. So anybody can basically give to your business, and maybe they get some of the first products that are out there. Maybe they get some shares in the business. So anyway, I always challenge founders that are starting a company, like, why venture? And the risk is that, you want to basically, your time is your scarcest commodity. You want to not spin your wheels for months and months and months, and just literally you can pitch 200 VCs, and VCs are notorious for not saying no. Like we try to do a better job and say this is not for us, meet these other folks, because we remember it as founders how frustrating that was. But VCs are notorious for not saying no. So literally you can do 200 meetings in a year, not get any no's, and say, what's going on? What's going on? And basically spin your wheels and lose so much time, right? Versus, you know, bootstrapping, raising a little bit of debt, raising a friends and family round. There's now something called a pre-seed round. That's kind of the first 100K to 1.5 million, even before us, even before seed. That a lot of people don't know about. There's probably 30 or 40 great pre-seed firms in this country, right? And we actually have invested in a lot of those firms because they're strategic to us. We get to see the good companies coming out of the pre-seed firm so we can lead the seed. But anyway, my point is VC is not for everybody. It's good to have the options and certainly talk to VCs to get feedback. But I'll be the first to say that it's not for everybody.
Yeah. Well, I love that you say this. I'm a very direct person. My background was Wall Street. And when I first got into this business, I would just be like, no, it doesn't work for these reasons. And I was like, geez, why does everybody hate me? And then I realized, oh, you know what? All these other guys just never say no. They never tell a founder what they don't want to hear. They won't say no. It's such an interesting thing. So, and I think that it can be really dangerous because, very often come across founders who are like, oh yeah, don't worry, we're good. Like we have this one firm that's like promised to give us a term sheet. And it's like, okay, we'll see how long that takes. So yeah, it's a lot of balls in the air at one time and very hard to get. And I love that you point that out because for some reason in the media, I feel like people have painted a picture that it's so easy for companies to get funded, but it's actually very, very hard, even for the best companies, to raise capital. So I just want to remind anybody that if you have questions, please put them into the Q&A. I'd love to make sure that Nihal has the opportunity to answer your questions. And one of the things that we did want to hear was if you could just tell us a little bit about an investment that you've made that maybe didn't work out as planned and what you learned from that experience.
Yeah, I mean, listen, we've made, I don't know, probably 200 investments through the fund and personally. And a lot of those, have not worked out. In each fund, you only need, in each fund for us, I mean, the math is, we 35 investments per fund. And reality is 3 to 5 of those 35 end up, being outliers. Today, we just announced one of the companies we seeded in 2016 called Attentive in New York, just raised at a $2.2 billion post money.
Congratulations.
Thank you. We didn't do anything, but have the opportunity to work with the founders actually now twice. And it's a long game. And like I mentioned, great founders will build many businesses. But that business is an outlier in that fund, right? And for that one huge kind of home run, you'll have 10 or 20 zeros, at the end of the day. So, some of the things that we learned from some early failures were the co-founder chemistry is incredibly important. And we know this in building our own startups. Many of them failed because of the team. And so we try to de-risk that as much as possible, obviously by working with ideally founders we backed before or founders that have done it before. But if not, founders that have worked with each other together before and like failed, so they had their hands around each other's necks, but they still want to do it again with each other. That means the world, right? That means you've been through hell and back with somebody and you still want to do it again, right? There's no greater sign that strong chemistry. But that's probably one of the number one startup killers at an early stage, right? It's just co-founders that are not optimal for each other.
Yeah. Well, I am so interested to see the value that you place on experience and relationships. So I think this is a great takeaway for folks that, as you said, it is a very long game and those things are important. Don't burn bridges, treat people nicely and be willing to learn from failures. So we have a couple great questions. The first one is from Tan Lee. Who asks, could you give a range for the size of a seed or A round these days in your mind, since it's a constantly shifting target?
Yeah, it's a good question. A's got real big. I mean, pre-COVID, last year, I think our median A was like 15 million bucks. There was a phase shift that happened where, seed rounds that we look at are 3 to 4 million bucks. Those used to be called Series A's 5 years ago. And 5 years ago, the $15 million rounds were Series Bs, right? So everything has kind of moved one phase over. And in the earliest phase, what we call seed, what we used to call seed is now pre-seed, right? And so everything's kind of phase shifted. But I'd say an average, I think what COVID has done is it's reset things a little bit more. And I think everybody thinks it will get further reset over the next couple of years. That, obviously from an economic standpoint, the next couple of years are probably going to be challenging, whether it's further recession or not. I think that it'll be harder for new funds to raise capital. And that means with less capital, the existing funds are more or less going to have to stay in their lane. And that means seed funds have to continue doing seeds and A funds have to continue doing A's. And so hopefully then the round sizes will go back to normal and prices will go back to normal. But to answer your question, the average seed round we see is 3 to 4 million bucks. The average A round is kind of 10 to 15. And so B's are north of that, right? We just did a Series B, announced a Series B last week for another New York company called Alloy. They're an API for banks and fintechs for Know Your Customer and anti-money laundering. And they raised a 40 million.
I actually have a little piece of that, so I'm familiar with the company.
Awesome. Awesome. Very, very good. Congrats. And that was a $40 million Series B, right? So Bs are, 20 to 50 million. A's are 7 to 15. Seeds are 3 to 4. Pre-seeds are 100K to 1.5. But you know what? All this can change tomorrow. So like, don't worry about the nomenclature. As a founder, by the way, work with the fund that fits you like a glove for your stage. So if you're a pre-seed, pre-product, work with pre-seed investors. If you're pre-revenue, work with seed investors, et cetera.
Okay. All right. That's a great answer. And yes, I think even in my mind, I probably wouldn't think that it would be so large. So yeah, it's a moving target and kind of, there's also sort of a huge difference depending on where you are geographically, right? So probably a lot larger size rounds happening on the West Coast even versus here. Okay, great. We have a question from Durand who asks, what is more important, the character of the entrepreneur or the potential of the product or service?
At seed, we think the latter is a function of the former. So we think, the founder will project if the founder is strong, founding team is strong, then they will project a strong market. They will go after a large market and they will have a unique product. It's a function of the founding team. From a character perspective, integrity and trust is paramount to everything, right? And credibility. If the character is compromised, then there's no way they're going to be successful. They're not going to be able to recruit. They're not going to be able to raise money. They're not going to be able to sell to customers. They're not going to execute. Execution is about, doing what you said you were going to do. And so that's directly reflective of character. So yeah, I think the latter. I think all the other stuff is based on the founding team. So I'd say character is most important.
All right, that's great. I totally agree. Doug Slattery asks, can you talk a little bit about scenarios other than, I guess, the exit to possibly pay back investors through revenue or future rounds? I mean, I guess a lot of people have
Yeah.
questions on that. Like, is it possible to pay back early investors?
Yeah, totally. I mean, a lot of our friends have done great things outside of tech. One of my mentors and a brother from another mother is a incredible Broadway producer, and we've invested in a number of his plays. His most recent one is Jagged Little Pill, and obviously we're sad that Broadway's on pause, but it'll come back bigger and better. And those businesses give off dividends, right? Those are set up to you own shares in an LLC, and after certain hurdles, they eventually make you whole, and then you share in the profits. So many businesses are set up that way, right? Not necessarily tech software businesses incorporated in the state of Delaware as an LLC, as a Class C or Class S corporation, but restaurants, most businesses are LLCs, right? And so, in any event, there's opportunities there to generate dividends and pay royalties back to your investors, in that manner. In our world, never happens.
Yeah.
In the 200 businesses we've invested in through the fund and personally, I don't think I've ever received a royalty check or a dividend. A lot of zeros. And then, you monetize investments when they go public or they're acquired.
Yeah.
Or you might be able to sell secondary as the companies grow, later stages, but that's also rare.
Yeah, don't count it. So I think that's really important that, your business needs to be structured in a way that's appropriate for the cash flow profile of your business. So great question. We have time for one more question from Rochelle Stewart. She asks, I'd love to hear Nihal's point of view on bringing on independent board members as a startup progresses from seed to Series A. Any lesson learned or advice you've shared with founders?
That's a great question. And actually, one of the things that we're very passionate about, and we encourage all of our boards to incorporate, is an independent board member with a diverse background. Many of these boards, and by the way, tech and venture capital is still all white dudes. And listen, nothing against white dudes. Many of my friends are white dudes. My partners are white dudes. But innovation comes from diverse perspectives. And the more diversity you can have around a boardroom, the more successful your company will be. And so, we highly, highly recommend, because a lot of the investors that invest in startups also are not necessarily representative of a diverse general partnership yet, although that's changing, that you bring in diversity through an independent board member. And actually, I'm a really lucky investor in a company called The Board List, personally. And The Board List is a directory of incredible women and underrepresented potential board members that a startup can inject in their board as an independent. So, yeah, huge advocate, highly encourage it. You did mention from C to A. Now, in reality, a board is not really formed until post A. A lot of our seed investments, majority are done as equity rounds, and there is a board. We just like that to create the discipline and the practice. But a bunch of seed rounds are still just convertible debt notes. And so these are, notes that founders raise, and it stays as debt. It'll convert to equity in a later round, but it's often more efficient to raise money that way for the founder. In those situations, usually a board is not created. So when we do notes, there's no formal board until the Series A. So when you think about an independent board member, that's usually a post-A kind of timeline for your company. Pre-A, you want to maybe get in the habit of having board meetings with a informal board once a quarter. but post-A, they will be more formal. And certainly as the company grows, um, you know, towards the BCT, whatever rounds.
Great. Well, I would definitely encourage folks to check out the board list if they're interested in board positions. And Nihal, I highly recommend Rochelle Stewart as a board member for independent board member for any of your portfolio companies. She definitely fits the bill of what you're looking for.
Very
So
cool.
thank you for that great question, Rochelle. And Nihal, I just want to thank you so much for joining us today. You really made our first episode truly special and informative. And if you're willing to share, how can people best connect with you?
Yep, I actually put in the chat. Twitter is highly addictive and contagious. So I will always respond to your tweet or a DM. Also, feel free to email me. I'll put in my email address. Um, we have 2 young boys, but after they're asleep, I usually try to go through my emails. You will hear from me within a week, or your money back. You're not paying me, so there's no money back. But anyway, I'll definitely get back to you. Just reference that we met, on this webinar. And one thing that we always try to do, and we remember as founders that this was very impactful. As founders, we had tons of VCs that passed on our businesses. Obviously, some invested as well, but the most vivid memories are the investors that maybe didn't invest, but they provided one introduction from their network that was highly valuable. They just unlocked something in their network that they thought of at that moment, and they made that connection. And oftentimes that connection would change the trajectory of a business. It would be somebody you would never be able to get to on your own. And so, now we feel like it's our responsibility to be able to unlock that network for other founders. So if there's anything we can do to help, I try to make at least one introduction of value to everybody that I meet. And again, or your money back. So.
Great. Well, thank you so much for your time today. And I want to thank everybody who joined us and made our first episode of the Series A list amazing. For those of you who had to leave early, we're going to be distributing a recording afterwards so that you can go back and recapture some of these amazing gems that we've learned. And don't forget to grab Nihal's contact information, email, and Twitter, and check out ENIAC Ventures, one of the top seed stage funds in the world. And we're really glad to have the opportunity to get to know you. So thanks, everybody. Have a great evening.
Thanks, everybody. Thanks, Erica.
Bye.